The dragon's slowed breath. An overview of China's economic deceleration. China's economic growth has been a global phenomenon for decades, capturing the world's attention with its rapid industrialization. The world watched as it rapidly industrialized, lifting millions out of poverty and transforming the global economic landscape. However, in recent years, the dragon's breath has slowed, signaling a shift in the economic dynamics. Economic indicators point towards a deceleration, with growth rates not as robust as they once were. This slowdown is driven by a confluence of factors, both internal and external. Internal issues like a property market bubble and rising debt weigh heavily on the economy, creating significant challenges. External pressures, such as trade tensions and geopolitical uncertainties, add to the complexity, making recovery more difficult. The once booming manufacturing sector faces headwinds, struggling to maintain its previous momentum. Consumer spending, while growing, hasn't fully compensated for the slowdown in other sectors, leaving gaps in economic activity. The Chinese government is acutely aware of these challenges and is actively seeking solutions. Stimulus measures and policy adjustments are being deployed, but their effectiveness remains to be seen, as the situation is complex. The world watches closely, as China's economic health has profound implications for all, influencing global markets and trade. The interconnectedness of the global economy means that a slowdown in China will inevitably send ripples across the world, affecting many nations.
India and the dragon's shadow. Analyzing the spillover effects. India, a rising economic power in its own right, closely observes the developments in China, its neighbor and major economic player. The two Asian giants are significant trading partners, making India susceptible to spillovers from China's economic slowdown. A decline in Chinese demand for Indian exports, particularly raw materials and commodities, could impact India's trade balance and overall economic health. However, this scenario also presents unique opportunities for India to explore and capitalize on. As Chinese manufacturing slows, some global companies might seek alternative manufacturing hubs, and India could be a prime candidate. India, with its large and increasingly skilled workforce, could attract some of this investment, boosting its own manufacturing sector. Furthermore, a slowdown in China might lead to decreased competition in sectors like textiles and electronics, where India has a strong presence. This could provide Indian companies with a chance to increase their market share, both domestically and globally, enhancing their competitive edge. India must be prepared to adapt and capitalize on these evolving dynamics to cushion itself from the negative impacts and leverage potential benefits, ensuring sustainable growth.
Across the vast expanse of the Pacific Ocean lies the intricate and multifaceted relationship between the US and China, often referred to as the Chinese economic puzzle. The United States, the world's largest economy, is deeply intertwined with China, the world's second largest economy. Their economic ties are both a source of strength and a point of contention. The two nations are major trading partners, exchanging billions in goods and services annually. However, their relationship is complex and often fraught with tensions, influenced by political, economic, and social factors. China's recent economic slowdown introduces a new layer of complexity to this already dynamic relationship. The ripple effects of this slowdown are felt globally. A slowdown in China could result in reduced demand for U.S. goods and services, affecting various sectors of the American economy. This could negatively impact American businesses, particularly those heavily reliant on the Chinese market for their revenue and growth. The ongoing U.S.-China trade war, characterized by tariffs and trade barriers, adds another layer of uncertainty to the economic equation, complicating trade relations further. However, the slowdown in China could also present unique opportunities for the U.S. American businesses might find new markets and innovate to reduce dependency on China. As China grapples with its internal economic challenges, it might become less assertive on the global stage, potentially altering the balance of power. This shift could provide the U.S. with an opportunity to strengthen its alliances, forge new partnerships, and reshape the global trade landscape to its advantage.
A world-entangled global ripple effects of the slowdown. The interconnected nature of the global economy means that China's economic slowdown will have far-reaching consequences. Countries heavily reliant on exporting to China, such as Australia with iron ore and Brazil with soybeans, will feel the pinch. Emerging markets, many of which have benefited from China's insatiable appetite for commodities, might face headwinds. The slowdown could also impact global financial markets. Uncertainty surrounding China's economic outlook might trigger market volatility and impact investor sentiment. Central banks around the world will need to carefully monitor the situation and be prepared to adjust monetary policies if necessary.
Section 5. Commodities Conundrum, the price of a slowdown. China's economic engine has been a voracious consumer of commodities, driving demand and prices for raw materials globally. A slowdown in its growth trajectory has direct implications for the commodities market. From oil and copper to iron ore and soybeans, a decrease in Chinese demand could lead to downward pressure on prices. This price dip could bring relief to some economies grappling with inflation, but it also poses a challenge for commodity exporting nations. Countries reliant on commodity exports for revenue might face budget shortfalls and economic instability. The ripple effect of China's slowdown on the commodities market highlights the interconnectedness of global trade and the need for diversification. Section 6. Manufacturing might face a test, uncertainty looms. As the world's factory floor, China's manufacturing prowess has been instrumental in supplying global demand for everything from electronics to apparel. However, the slowdown casts a shadow of uncertainty over the future of global manufacturing. A decline in Chinese domestic demand, coupled with rising labor costs, might prompt manufacturers to seek alternative production hubs. This shift could benefit countries like Vietnam, Bangladesh, and even parts of Africa, which offer lower labor costs and are eager to attract foreign investment. The slowdown presents both challenges and opportunities for global manufacturers. Adapting to shifting demand, diversifying supply chains, and embracing automation will be crucial for navigating this evolving landscape. Section 7. Tech Titans and the Tremors, navigating the Chinese slowdown. The technology sector, a key driver of global growth, is not immune to the tremors of China's economic slowdown. The Chinese market, with its massive consumer base, has been a lucrative one for global tech giants. However, a slowdown in consumer spending in China could impact the bottom lines of these companies. Moreover, the slowdown coincides with China's increasing focus on fostering its domestic tech champions. This push for technological self-reliance could lead to increased competition for global tech players in the Chinese market. Section 8. Shifting sands of investment capital flows in a slowdown. China's economic slowdown has implications for global capital flows. As uncertainty surrounds the Chinese economy, investors might become more risk-averse, potentially leading to capital flight from emerging markets, including China. This shift in investor sentiment could impact infrastructure projects, particularly in developing countries that have come to rely on Chinese investment. However, it could also create opportunities for other regions, as investors seek alternative destinations for their capital. Section 9. Lessons from the past. Echoes of economic slowdowns. History is replete with examples of economic slowdowns and their ripple effects. The 1997 Asian financial crisis, the 2008 global financial crisis, and even the more recent Eurozone debt crisis offer valuable lessons. These crises underscore the interconnected nature of the global economy and the importance of proactive measures to mitigate risks. One key lesson is the need for diversification. Over-reliance on a single market or sector can leave economies vulnerable to shocks. Building resilience through economic diversification, both in terms of markets and industries, is crucial.
Section 10. Charting a course, future precautions and collaborative solutions. Navigating the challenges posed by China's economic slowdown requires a multi-pronged approach. Individual countries can take steps to strengthen their economies and reduce their vulnerability to external shocks. This includes fiscal prudence, maintaining sound fiscal policies and avoiding excessive debt accumulation. Structural reforms, implementing reforms that boost productivity, enhance competitiveness, and attract foreign investment. Social safety nets, strengthening social safety nets to protect vulnerable populations from the impacts of economic downturns. Beyond national-level actions, global cooperation is essential. International institutions like the IMF and the World Bank have a crucial role to play in providing financial assistance, technical expertise, and a platform for policy coordination.